Good afternoon. This is the Tech Report. The internet IPO frenzy caused by Facebook and more recently Twitter is drawing investors that just went in on any internet IPO. Both Facebook and Twitter stocks got off to a slow start. It was almost a year before Facebook stock recovered its initial loss in stock value. Twitter is still down from its initial launch, although it is just starting to crawl back. Zulily is the latest example. This online apparel children's store initially planned to price its shares between $16 and $18 a share. It increased the range to $18 to $20 a share and then finally priced it at $22. It's now trading at approximately $36 a share, popping on its first day. Zulily says the children's boutique market is fragmented, but children's clothing is available just about everywhere, and if it's discounted designer wear you want, you can go to Gilt Children's section and find designer deals for kids. Zulily claims it is transforming the way moms shop online and that it is a disruptor. There is nothing new or unique about a discount online apparel store. What these new shareholders seem to have overlooked are the numbers. While Zulily is shouting about its huge sales growth, the company has incurred significant losses, $11 million in 2011 and $10 million in 2012. Plus, it has accumulated a deficit of $57 million as of September 2013. Its expenses are skyrocketing as well. The company warns that it may not be able to keep up this growth or have enough sales to cover the rising expenses. Zulily also depends on the flash sale model. We've seen how well that has worked for Groupon. Zulily calls the flash model challenging. Wait, you say you depend on this model and then you say it's challenging. The real problem that many shareholders may not realize is that they have no voting power. 99% of the voting power lies with the executives. If you don't like the CEO, guess what, shareholders? You can't do anything about it. You do not have a vote. And here's one more problem. The company filed a confidential order with the SEC on the day it went public. It states that it excluded information from the exhibits from its S-1 filing with the SEC. Zulily then asked that the information not be disclosed until 2015. The SEC granted this request. What is Zulily hiding that they don't want shareholders to know about for 2 years, filed the very day they go public? Now, investors are probably looking at the executives and board members and figured that it looks like a good lineup, so this must be a good deal. The co-founders are from Blue Nile, and internet winner Zillow CEO Spencer Rascoff, well, he's on the board. But that doesn't change the fact that new shareholders have no voting rights, the company loses money, has significant debt, and is keeping information from its shareholders with the blessing of the SEC. I'm Deborah Borchardt, and this has been the Tech Report.